Yo, what's going on, everybody? I'm back in LA, Los Angeles. Nice weather. Not like New York. It was freezing there, folks. It's been a while since I was running at 4 a.m., 30 degrees, 28 degrees, but I was back doing it again while I was here. Anyway, nice to be back here in the nice weather. Not a lot to talk about, just the same dynamic continues. We've got a couple of things intermixed here. Of course, we got the monetarist zombies who are now exiting bearish positions that they had on for the last almost 2 years, which they were completely wrong on that view. As I've said over the course of the past 2 years, how rate hikes were going to be positive, both for the economy and the stock market, because they equate to fiscal transfers, and we've seen this. The numbers are very clear on this. And, you know, there's that FOMO buying going on, fear of missing out. One of the things that's interesting is that looking at futures commitments, you know, that CFTC Commitments of Traders report that comes out every Friday. Back in October, when we had that correction, institutional asset managers were heavily liquidating their long futures position at the bottom. Okay, I think that was like the week ending October 23rd when we made that spike bottom. I mean, and if you go back, and if you watch my videos around that time, I was saying, you know, this is a buying opportunity. This is a buying opportunity. I was spelling out for you, you know, the next 3 months, how we're going to get through the December tax drain, which, by the way, wasn't much of a tax drain at all. And then it was going to be positive through the end of the year into mid-February. And that's exactly how it played out. But again, institutional asset managers liquidated a significant percentage of their long S&P futures position at the bottom. Okay? Now, what do you think they're doing right now? Because the latest data, which I just looked at on Friday, you guessed it, they have jumped back into the market and have now built a long position that is the biggest in over 2 years. So just reflect a little bit on this behavior. These are institutional asset managers. These are the pros, so to speak, okay? At the bottom in October, they were panic selling. And I did a lot of videos back then about emotion, about panic, how you have to be strong, how you have to be resilient, how you have to go against emotion, how you have to control your own emotions and not panic, not get emotional. Even keel is opportunity. So many times I've talked about consumer behavior, how we love it as consumers when things are on sale, our favorite items. And yet when it comes to investing, oddly, strangely, people tend to do the exact opposite. They want to pay high prices. So back in October, you literally had, you know, you talk about Black Friday shopping after Thanksgiving, when everybody runs out or goes online and gets their favorite deals. You had that happening in October, and institutional asset managers, the pros, okay, they were selling like crazy. And now they're buying like crazy, all right, at all-time record highs. This is not the kind of behavior that you would take as sane, as rational, as constructive. I mean, I look at this, and to me, it's just striking how self-sabotaging this behavior is. But again, these people all act in unison. They all act like sheep. Their understanding of the monetary system is nil, zero, zilch. They have it all backward, as the last 2 years can attest. And I can tell you now that looking forward into 2024, if indeed the Fed does cut rates, now don't forget, they're jumping in right now. This is kind of like a front loading of the rate cuts, okay? They're not even waiting for the rate cuts. They're buying right now in anticipation of the rate cuts. So this market move that we're experiencing right now, in my opinion, I think is discounting a significant amount of the bullish effect that we would get off of the rate cuts, all right? They're front loading their buying right now. And just as they had the dynamic wrong, the understanding wrong with the rate hikes, in the sense that rate hikes were a fiscal transfer, you had an increase in interest income transfers into the economy. It became very, very powerful. It offset the negative effect of discounted forward cash flow. The opposite effect is going to occur next year when we get the rate cuts. Rate cuts equate to fiscal contractions, at least in the sense of reducing interest income transfers. And it can be very significant. I went back and looked at previous periods of rate cuts and the amount of interest income that was reduced from personal income, and it was a significant figure. And all during the period of rate cuts, and you can go back historically and look at these, we've had subpar economic growth. And that is, you know, this 5.6%, 6%, 5% economic growth, which is unusual for the United States, you know, at least in recent history, but it has become the norm recently. We'll go back to that 2.5%, 2%, maybe if we're lucky, 3%, maybe sometimes 1.5%. It's okay for stocks. I mean, I've always said that growth is bullish for stocks. But the speed of growth, the rate of growth, also determines, you know, the rate of rise in the stock market. And we've had a very substantial, rapid rate of rise, I can tell you right now, which in my opinion does not reflect the fact that we had a slowdown in the fourth quarter. We went from like 5.6% GDP growth in the third quarter to, I think, now about 2.5%. So it's been cut in half, maybe a little bit more. And stocks are reaching all-time highs, have hit all-time highs. I'm not bearish on the stock market, but I do think that a correction, a pullback is in order based on the fact that we've had a growth slowdown. Stocks are ahead of themselves. And also, just from what I said earlier, that if you look at behavior of the large professional players in the stock market, to me, that's really all you have to know. You look at what they did in October, which if you had done the exact opposite, which by the way, I told you to do the exact opposite. And I'm telling you right now that more than likely, if you do the exact opposite of what they're doing right now, I mean, how many times have I said that going against emotional behavior is probably really the only thing you need to know? Like, throw away for a second the economic understanding, the MMT understanding, the understanding of the monetary system, of the effect of policy on economics. If you throw all that away, you literally can invest profitably if you go against these swings in emotion. But it would also necessitate that you have control over your own emotions. A lot of people have a problem with that. That's why when people say, oh, let's look at your track record, I said, you cannot make money from following somebody else's track record, because every person is an individual. Every person has different levels of risk tolerance. Every person has different levels or ability to control their emotional state. So that's kind of like a ridiculous question to ask, because even if I gave you every single buy and sell point, there are going to be times when you feel uncomfortable and you're going to do something to sabotage, whereas maybe I would not, or maybe I would and you wouldn't. Okay, I'm human too. I am prone to, from time to time, emotional decisions, even though I've spent my entire trading life and career, not the entire, but at least the second half, when I started to learn that this was all about behavior. I spent a lot of time working on myself, and I've said to you guys that when things like this happen, when it gets hard, when it gets tough, when it gets stressful, when your anxiety is shooting through the roof, the best way to look at that is that's an opportunity to train yourself mentally. It's all about framing. You could frame those periods as, oh my God, what's happening? This is horrible. I'm stressed out. I can't take it. Or you can frame that period as, hey, this is something good. I can learn from this. I can come out of this stronger. I can get through this. It's all about framing. All about framing. Anyway, that's the update for today. We're going to be, this week is it's kind of thin anyway. People are on vacation. They're going to be on vacation into the first or even the second week in January. We'll start to pick things up after that. February 15th is another quarterly interest payment. Then we get into those big months. And by the way, starting next week is the beginning of fourth quarter earnings are going to be reported. That's going to be interesting because we got a little bit, I think, a little bit of a hint of that last week with the FedEx announcement of a slowdown in profits. And we're going to see how companies did in the fourth quarter with the slowdown in economic growth. Remember, I've said this before and I'll say it again. The stock market follows the economy, not the other way around. It may look like it's the other way around, but believe me, it's not. If the economy is growing, the stock market's going to go up. If it's growing fast, if the rate of growth is rapid, stock market's going to go up fast. If the rate of growth is slow, stock market's going to go up slow. It's going to meander. It's going to take its time. But growth is the key, and vice versa. If it's contracting, if the economy's contracting, if we're in a recession, stock market's going to go down. So next year's a new year. Like I said in my prior video, it's going to be another opportunity to take money away from these monetarist zombie folks. Knowledge is a powerful thing. I know that's a cliche. You've probably heard it a million times, in different contexts. But it's true. What can I tell you? I'm still seeing headlines saying how everybody got things wrong in 2023. Well, yours truly didn't get it wrong. And that's not to pat myself on the back. That's to say, I understand how the monetary system operates. I understand the effect of policy on the economy. Those others who got it wrong, they are stuck in a false paradigm. They are stuck in a kind of a mythology that exists in their heads but doesn't exist in the real world, in the applied sense. Like I've always said, I'm the only guy who has an applied MMT program. I take the concepts and understandings of MMT and I show you how to apply that to make money as an investor in the financial markets. So if you want more, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. Have a great week. I'll probably see you again at least once this week. Bye.